The S&P 500 yesterday returning to positive territory for the year. The NASDAQ hitting a new all-time high yesterday. Right now, we've got a decline of 330 points on the Dow Industrials. The S&P is down 33 and the NASDAQ down 59. The National Bureau of Economic Research says that the COVID-19 crisis launched the U.S. economy into a recession in February, marking the end of the longest economic expansion on record. Joining the conversation this morning, Optimal Capital Director of Strategy and Market Analyst Francis Newton-Stacy is here, along with Fox Business's Dagan McDowell, the Wall Street Journal senior writer John Hilsenrath, and the National Taxpayers Union senior fellow, Forward Strategies President Mattie Duppler. Great to see everybody this morning. Good morning.
Great to see you.
Great to be here, Dig.
Good morning, Maria.
Good morning.
So, Francis, let's talk about that the recession started in February. What do you think in terms of where we are and how severe that recession will get?
Well, it's very interesting because no recession since the 1800s, I guess, has been shorter than 6 months. So I guess the question on the table is this recession going to be the shortest recession in history? And that all depends on the rebound of GDP, of course, which those estimates are still kind of coming because could we lose 50% in the second quarter? There are all these estimates that are going out there. And then how could we have the biggest uptick in GDP with the reopening in the third quarter? So this all remains to be seen. But thus far, we're in recession. And could anyone view it positively that we don't actually hit a depression, as that was also once on the table?
Francis, what does that mean for the backdrop for investing right now? Would you be allocating capital depending on where we are with this recession?
I think that the stock market's gotten a little ahead of itself as far as multiples go. The labor market always lags equity markets, and I think the labor market is probably going to take longer to return than maybe some of us suspect with the reopening. So I think that we're a little bit extended. I do think that there are some good deals in international value, international stocks, and emerging markets. If the dollar stays on the decline, we'll have to watch the dollar. It's having an uptick today and see if strong dollar remains, then the recovery is kind of going to be slower in those areas. But if the dollar continues to decline, then that's going to be a good, cheap place to go. I think the U.S. markets are a bit extended.
Well, we'll see if the dollar declines or moves today. The Federal Reserve kicking off a two-day meeting today. The Fed announced yesterday significant changes to improving the lending program that was designed to help small and mid-sized companies. So, John Hilsenrath, what are you expecting out of this Fed meeting? And jump in here with Francis.
A couple of things. On the Fed meeting, it looks like the Fed, like a lot of the rest of Washington, wants to see how the economy plays out over the next couple of months before it does another action. The big question is whether how much the Fed keeps buying in Treasury bonds. On that NBER recession dating that you mentioned, one of the things about the NBER is they often put out these recession dates after the recession is already over. The Wall Street Journal has been reporting over the last couple of weeks that it looks like activity bottomed out sometime in May, and that as states reopen, we're going to start seeing a response in activity. The question, I think, is how long it takes to get back to where we were in February.
Yeah, it just completely remains to be seen.
Yeah. Go ahead,
it's
Francis.
just interesting because, some businesses have had to go to skeleton crews, and some of them will be very hesitant until the demand comes back to kind of, come back with a full set of employment. And then some things will open up and spark right back, or the jobs that were temporarily laid off, people will get employed again. And then some people have permanent job losses. It just sort of remains to be seen. I think the sector where the permanent job losses are going to occur is sort of the lower echelon of the economy, which is going to increase the wealth gap, but could cause more of a, rebound in some of the industries. It's just going to increase that wealth gap.
Mattie.
Francis, you said that the labor market lags equities typically, but man, that Friday jobs number was way better than anyone expected. Do you think that the recovery is starting sooner than perhaps you had expected, or do you still expect to see that labor market lag as we go into the summer months?
I think the last part of the labor market's going to lag. So I've seen estimates that 42% of the jobs lost are actually going to be permanent, which kind of lands us in sort of the 8% unemployment. And then typically, employment comes back at, 0.5% to 1% each year. So if you look at that, that's quite an extended, comeback. But I think that the headwinds ahead are, we've taken care of the PPP, which was going to expire, which is great. Taxes are due on the 15th of July. You have, airlines got their, bailout money because they were supposed to keep employees through the end of September. We'll see if that occurs after that, date passes. And of course, the furlough and the mortgage and, rental markets are going to end at the end of October. So those are kind of the headwinds that could catch some of these things by surprise when the stimulus starts to taper.
All right, we will be watching it all. Francis, great to see you this morning. Thank you so much. Francis Newton, Stacey joining us this morning on the economy and markets. We're just getting started this morning.